Corey from LaPlante Management. In the last video, we talked about the chart of accounts and why the way you set up your accounting structure matters. In this video, we're going to take a look at reporting and reinforce the idea that how your accounts are built and where you put them will determine what you're able to see. If we've built our chart of accounts in a way that splits transactions into an appropriate number of buckets, and we put the buckets into the proper places to separate income, expense, assets, liabilities, and so on, then we're ready to report on that information. Let's start at the reporting finish line, then we'll go back and actually walk the race course. The end result of any of these reports should be actionable change. In the case of expenditures, that might be something along the lines of, now that my financials have revealed this previously hidden spending, I can make changes that save me money. Or with income, now that I recognize that product A is not only twice as popular as products B and C, but also twice as profitable, I'm going to feature product A in more marketing materials. So we know what we want, but we don't actually get to start at the end of the track. Let's go back to the beginning and take a look at a couple simple but strangely underutilized areas of reporting. First, let's talk about time frame, or what in accounting speak we might call reporting period. When you're looking at any report, whether that's your basic P&L or balance sheet or something else, you first want to identify the primary window of time that you want to look at. Sometimes, all you need to do is answer a simple question, like how much did we earn or spend in Q1? Now, sometimes we want to compare two or more periods against each other. And in any of your more popular accounting softwares, this is super easy. But like I was saying earlier, pretty underutilized. Anytime you can, give yourself some context. If we go back to how much we earned in Q1 and it was $100,000, that might be great or it might be terrible. If we can compare that against the previous quarter or Q1 from the previous year or the previous 10 quarters, that will give us a lot better idea of how we did. If that previous period was $1 million, we probably shouldn't celebrate $100,000 in Q1. But if it was $1,000, then let's go buy a fancy pizza and celebrate. That context that we get from comparisons is critical when it comes to identifying trends, whether those trends are positive or negative. At first, you might be disappointed to hear me say that there's really no magic when it comes to reporting. If you build a system that breaks your transactions down into manageable buckets, and you evaluate those buckets in the proper time frame and context, trends and outliers can't help but reveal themselves. Then it's just a question of what you're going to do with that information. If you get bogged down looking at numeric reports, there is software out there to help you translate those numbers into visual representations. And you can see more on our website about our favorites, and if you want, we can help you set them up. Here's what I hope you take away from all of this. Accounting systems can seem really complicated at first, but with a little bit of planning, you can set yourself up to track the information that matters to you and get honest-to-goodness, actionable insights out of it. I'm Corey with LaPlante Management. Thanks for watching.